Hey everyone, welcome back to the channel. If you're new here, this is your go-to spot for everything stocks, trading, and investing. Today, we're tackling a question that's been debated for decades. Does technical analysis really work? Whether you're a day trader glued to your charts or a long-term investor who thinks technicals are just noise, this video is for you. We're going to explore the origins of technical analysis, how it's used, what the data says, and whether it actually gives traders an edge. So grab a coffee, settle in, and let's break it down. Let's start with the basics. Technical analysis is the study of price and volume data to forecast future market behavior. It's based on the idea that market prices reflect all known information, and that patterns in price movements tend to repeat over time due to investor psychology. Unlike fundamental analysis, which looks at earnings, revenue, and macroeconomic indicators, technical analysis focuses purely on the chart, price action, volume, and indicators. Technical analysts use a wide range of tools. These include trend lines, moving averages, oscillators like RSI and MACD, candlestick patterns, Fibonacci retracements, Bollinger Bands, and support, resistance levels. The goal is to identify trends, reversals, and momentum shifts that can help traders make better decisions about when to enter or exit a position. There are two main schools of thought within technical analysis: classical charting and quantitative technical analysis. Classical chartists look for recognizable patterns like head and shoulders, flags, and double tops. Quantitative analysts, on the other hand, use statistical models and backtesting to validate strategies based on historical data. Technical analysis has been around for centuries. Its roots can be traced back to 18th century Japan with the development of candlestick charting by rice trader Munehisa Homma. In the West, Charles Dow, yes, the same Dow from the Dow Jones Industrial Average, laid the foundation for modern technical analysis in the late 19th century. His Dow theory proposed that markets move in trends and that price discounts everything. Over time, technical analysis evolved. The 20th century saw the rise of legendary traders like Richard Wyckoff, Ralph Nelson Elliott, and W.D. Gann, each contributing their own theories and methods. In the 1980s and 90s, the rise of personal computing and charting software made technical analysis accessible to retail traders. Today, it's a core part of many trading platforms and strategies, especially in fast-moving markets like Forex and crypto. So, does it work? Let's look at the arguments in favor. First, technical analysis provides structure. It gives traders a framework for decision-making that's based on observable data rather than emotional speculation. For example, using a moving average crossover strategy can help traders avoid chasing stocks during hype cycles and instead wait for confirmation of a trend. Second, technical analysis can help with timing. While fundamentals tell you what to buy, technicals can help you decide when to buy. For instance, a fundamentally strong stock might be in a downtrend due to market sentiment. Technical analysis can help you wait for a reversal before entering. Third, there's evidence that certain technical strategies have statistical validity. Momentum trading, which is rooted in technical principles, has been shown to outperform in certain market conditions. A study by Jagadish and Titman in the 1990s found that stocks with strong recent performance tend to continue performing well in the short term, a phenomenon that contradicts the efficient market hypothesis. Moreover, many institutional traders and hedge funds use technical analysis. High-frequency trading algorithms often rely on price-based signals to execute trades in milliseconds. If technical analysis were completely useless, it wouldn't be part of billion-dollar trading systems. But let's not ignore the critics. One of the biggest arguments against technical analysis is that it's based on patterns that may not have any real predictive power. Skeptics argue that seeing a cup and handle, or bull flag, is no different than seeing shapes in clouds. It's subjective and prone to confirmation bias. The efficient market hypothesis, EMH, proposed by Eugene Farmer, suggests that markets are so efficient that past price movements cannot predict future ones. According to EMH, any edge from technical analysis should be arbitraged away quickly. In other words, if a pattern works, everyone will use it, and it will stop working. Another criticism is that technical analysis can become a self-fulfilling prophecy. If enough traders believe a stock will bounce at a support level, they'll buy at that level, causing the bounce to happen. But that doesn't mean the analysis was predictive, it just means the crowd acted on it. There's also the issue of overfitting. Many technical strategies work well in backtests but fail in live trading. This is because they're optimized for historical data and don't adapt well to changing market conditions. A strategy that worked in a bull market may fail miserably in a sideways or bear market. One reason technical analysis persists is because markets are driven by human behavior, and humans are not always rational. Fear, greed, herd mentality, and overconfidence all play a role in price movements. Technical analysis attempts to quantify these emotions through price patterns and indicators. For example, RSI measures whether a stock is overbought or oversold, which can reflect investor sentiment. Candlestick patterns like doji, or engulfing, can signal indecision or reversal. These tools don't predict the future, but they offer clues about what traders are thinking, and that can be valuable. Behavioral finance, a field that studies how psychology affects investing, supports the idea that markets are not perfectly efficient. Traders often overreact to news, chase trends, and panic during drawdowns. Technical analysis can help identify these moments and capitalize on them. In practice, technical analysis is most commonly used by short-term traders, day traders, swing traders, and scalpers. These traders rely on chart patterns and indicators to make quick decisions. For them, fundamentals are too slow-moving to be useful. But even long-term investors can benefit from technical tools. For example, using a 200-day moving average to identify long-term trends, or watching volume spikes to confirm breakouts. Technical analysis can also help with portfolio management, setting stop-loss levels, identifying rebalancing opportunities, and avoiding emotional trades. It's also worth noting that technical analysis works best in liquid markets with high volume. In thinly traded stocks, patterns can be misleading due to low participation. That's why many traders prefer large-cap stocks, ETFs, or forex pairs where technical signals are more reliable. So, does technical analysis really work? The answer is nuanced. It's not a magic bullet, and it won't make you rich overnight. But when used properly, with discipline, risk management, and realistic expectations, technical analysis can be a powerful tool in your trading arsenal. It works best when combined with other forms of analysis. For example, using fundamentals to select stocks and technicals to time entries. Or combining sentiment analysis with chart patterns. The key is to treat technical analysis as one piece of the puzzle, not the whole picture. Ultimately, the success of technical analysis depends on the trader. A disciplined trader who uses technicals to manage risk and follow a plan will likely outperform an emotional trader who chases every breakout. Like any tool, it's only as good as the person using it. Thanks for watching. If you enjoyed this deep dive, make sure to like, subscribe, and hit that notification bell. Drop a comment below. Do you use technical analysis? Has it helped your trading? I'd love to hear your thoughts. And stay tuned for more videos on trading strategies, market psychology, and stock analysis. Until next time, trade smart and stay curious.